and welcome to our webinar. Today we're going to talk about private lending and a self-directed IRA. We're going to talk about a bunch of different kinds of private lending, ways to put deals together, what you can and can't do, and of course, types of accounts that can be self-directed. My name is Larissa Greene, and I'll be talking to you today about structures of private lending deals that we have seen here at Advanta IRA, and just again, reminders of things you can't do in an IRA. So there's a lot of different ways that you can lend money. You can lend it secured, unsecured, and of course, when we think of security, we typically think of real estate, but there are other ways to secure notes, and so we'll talk about that. And we're also going to talk about how an IRA can borrow. I am Director of Education and part of the business development team, and I've been with Advanta IRA since 2011. My contact information is here, so you can reach out to me with any questions, but I'm happy to take questions during the webinar. So please feel free to type any questions you have into the question box. You'll see that on the right-hand navigation of your screen. You're also going to see a handout section where I've uploaded the slides. So if you'd like a copy of the slides, please feel free to download them from there. And like I said, just get your questions typed into the chat box and I will answer them as I go. Advanta IRA and its employees do not provide investment advice. We also do not provide legal or tax advice. So please make sure that if you have any questions specific to your IRA account or the investment you're making, that you work with your team of professionals. If you're not sure if it's a question we could answer, please feel free to ask it and I will let you know if you actually need to reach out to someone else, and we may be able to refer you to a few professionals that can assist you that have helped our clients in the past as well. We're going to talk a lot today about different things that we have seen in retirement accounts, but there's going to be just 3 key points I want you to take away from this presentation. You can always refer back to the presentation. You can always reach out to us with questions, but the key points from today's presentation are listed here. So any IRA or former employer plan qualifies. You choose the investment. Remember, we don't sell anything at all. We simply provide a service. And all expenses are paid by the retirement account and any income is received by the retirement account. So those are very important takeaway points. And as we go through this presentation, you're going to see this as a common theme when we talk in the case studies about how investments are handled and how income is handled for retirement accounts. So here's our agenda, and we do have a lot to get through, but I think all of these items are important when you're talking about private lending. So I'm going to tell you a little bit about Advanta, and then we're going to talk about the self-directed accounts and how self-directed IRAs work. We'll talk about private lending basics, loan types, how an IRA can lend, and how an IRA can borrow. So Advanta IRA has been in business over 20 years. Actually, I think we're on our 23rd year at this point. And we have always been, an administrator for retirement accounts and some savings accounts, which I'll talk about momentarily. We can help you with those accounts that you'd like to self-direct, and it's not an all or nothing strategy, so you can move over just what it is that you want to self-direct. We have a little over $3 billion in assets under administration, and every single one of our clients receives a dedicated account manager who will provide them service for the life of the account. So you know who you're reaching out to when you have questions about transferring funds into the account, making an annual contribution, taking a distribution from the account, or even making an investment. So that individual services your account, it is there with you. And that way you have the opportunity to get to know that person and they get to know you and the investments you're making. And that really helps us move the process along for investments in the future. We have events going on all the time. They're always no cost, no obligation. We usually have 2 webinars a week, for example. We also have our own networking event once a month. We also have a podcast and a blog where we're keeping you up to date on everything going on in the industry. So if you're interested in that, check out advantaira.com for more information. So let's get into it. So what is a self-directed IRA? I think many of us have heard this term and we think, okay, well, that means I can choose the investments, but we're going to go a little bit deeper here and say, not only can you choose the investments, but these investments are outside of the market. So I know brokerage firms do tend to offer a self-directed option, but those are still going to be market-based investments. Here we're actually talking specifically about investments outside of the market. And remember, we don't sell anything at all. We simply provide a service. So we hold the account, You find the investment, we help you get it done in the name of the retirement account so that it retains its tax deferred or tax-free status. And so we're really truly talking about more unique investments than just market-based assets. Now, the benefit here, of course, is going to be true diversity. You can open up an account, move over just what you want to self-direct, and now you can have some investments outside of the market. What types of investments can self-directed retirement accounts make? Well, typically, I like to say the sky is just about the limit. There are some things you can't do, but the IRS has not provided us a list of items or investments that you can do with a retirement account. Instead, they've said, here's what you can't do, here's who you can't invest with. But just to give you an idea, we do typically see a lot of real estate investments. So people buy and hold single family homes, condos, duplexes. They invest in limited partnerships that hold real estate, maybe commercial investments. They also might have mobile home parks and multifamily. We see a lot of mortgages and notes, private placements. We also do see precious metals, and this would be actually the IRA actually holding gold and silver bars and coins and other types of precious metals. Cryptocurrency, of course, syndications I mentioned, and then the list really goes on and on. We see people invest in things like startup companies. They might invest in things like oil and gas rights, different types of holdings that might be linked to different types of assets. And we'll talk a little bit about things like secured notes, secured by non-real estate assets. And so if you can think it up, as long as it's investing outside of your personal assets, it's probably something you can do in a retirement account. So what types of IRAs can we hold? And you're going to see, for whatever reason, a lot of times people will say to me, well, I don't have a Roth IRA, so I can't invest in real estate and private loans. And I'm not really sure where that comes from, but the truth is you can invest in using any account that ends in IRA, and then you're going to see a few additional types of accounts here. So a question did just pop up regarding the previous slide. Can you invest in REITs? Yes, you can invest in REITs. I know sometimes there are REITs that are publicly traded, so we can't hold anything publicly traded, but if it's a private REIT, yes, absolutely. So plans for individuals are going to include traditional IRAs and Roth IRAs, and I think those are the most common types of investment accounts we see for retirement. And then, of course, an inherited IRA. So if it's something that you inherited, you can also self-direct an inherited IRA. Savings accounts like health savings accounts and education savings accounts can be self-directed. The rules for self-directing those accounts are exactly the same as IRAs, and so we can hold those accounts for you as well. And then plans for small businesses, that includes solo 401ks, SEP IRAs, and simple IRAs. And a lot of times people think of small business as in, okay, well, it's the business owner or business partners and then, several employees. But we typically are working with sole proprietors and independent business owners with no employees. And so we can certainly help you if you fall into that category with a plan for a small business. Even if you have a W-2 or 9-to-5 job, so to speak, if you have a side hustle, you could still be eligible for a small business plan. So I just like to clarify, because when we talk about investing, you're going to see that there's the opportunity to make, a good return in your retirement account. Of course, all returns are based on the investments that you make, but a lot of times people get earnings and contributions confused. And so a contribution is the amount you can put into a retirement account on an annual basis from personal funds or sometimes employer funds, depending on the type of account. But this is not to be confused with earnings. So if you have, for example, a traditional or a Roth IRA, this year you can put $7,000 in or $8,000 if you're over the age of 50 as your annual contribution. So that's money from your pocket, essentially, into the retirement account. But this has nothing to do with your earnings. Your earnings are unlimited. So if you put your $7,000 in and you make an investment and you have earnings, those earnings are not competing with the amount you're contributing on an annual basis. And since they're unlimited, if you make your investment and you have some windfall expected from that investment, you don't have to be concerned about earning too much, so to speak. So I mentioned we're going to talk a little bit about what you can't do in a retirement account. And I think this is important, especially when we're talking about private lending, because sometimes I get asked about lending money by the IRA account holder to themselves, and that actually would be prohibited. So the IRS wants you to make investments with non-disqualified third parties, is sort of how it's termed. And that means investments made should be made at an arm's length. So you can't lend money to yourself or to your spouse, to your children or grandchildren, parents or grandparents, and then that includes spouses and business entities of those. So the transactions that your IRA is involved in must be with non-disqualified third parties. So prohibited investments include just two categories of investments: life insurance and collectibles. So those are the investments you can't make. Some coins are allowed if the value, their value is based on trading value of the metal. So keep that in mind, because we did talk about precious metals, but of course there are going to be some coins that are considered rare or antique, and those would not be investments you could make in your retirement account. Prohibited transactions, again, any transaction between the plan and disqualified person. And I mentioned those disqualified persons a moment ago, and we're going to go on to the next slide where you're going to see a chart of disqualified persons. And then just something to be aware of, unrelated business income tax is a tax that applies to a retirement account, usually in two situations. So typically, you're not going to see an IRA pay tax on earnings. That is not something you see on a regular basis. Of course, the goal here is for tax deferred growth or tax-free growth, depending on the type of retirement account that you hold. But there are times that unrelated business income tax applies. It applies if, one, business income, even though IRAs typically receive passive income, if business income is being returned to the IRA. So if you make an investment and instead of passive returns, you're receiving business income, then business income tax could apply. Or when your IRA finances the purchase of an investment. And of course, there's, an exception to this. There's ways to mitigate unrelated business income tax, but we're really not going to focus on that today on today's webinar. But we actually did do a webinar last week. So if you're looking for more information about unrelated business income tax, please feel free to visit our video library. We have it there as well as on our YouTube channel. And if you can't find it, please feel free to email me. My contact information will be at the end again. And I can definitely send you the link regarding unrelated business income. So I mentioned we have a chart kind of outlining who would be considered a disqualified person when it comes to your retirement account. So IRA holder, of course, as I mentioned, and spouse, parents, grandparents, children, grandchildren, and then spouses and business entities of those. And so again, no lending money to yourself or to your spouse. You can't lend money to your business, to your LLC. No lending money to your children. And sometimes people will say, well, what if it's a first mortgage? It's fair market value, there's collateral. It still does not matter. That does not make it an allowed investment. So you want to make sure that you're dealing with non-disqualified third parties when you're talking about your retirement account. All right, let's talk about types of private lending. There are a lot of different ways to lend money. The terms that are in a specific or, part of a specific note are going to be up to the IRA holder and the borrower, and we're going to talk about that in just a moment. But let's talk about what we typically see. So a traditional mortgage is something that we don't normally see in an IRA, but it is something that I have seen, and people do like to do traditional mortgages. That's 15-year, 30-year lending. It does include balloon notes, but that would be something typically you're going to see amortized. So payments coming back are going to be interest and principal. It's being paid down over time typically, and it might not be paid off. It might not fully amortize, and it might have a balloon at the end, but you do see those longer term notes in an IRA. Something maybe a little more common in a retirement account would be short-term lending, transactional funding, something that's a year or less, sometimes smaller amounts just to help someone get through a deal. There could be unsecured promissory notes, and we do see those, and they are to individuals and to businesses. We see a lot of equity participation or joint ventures, and I have an example of that towards the end. And then, of course, secured notes by non-real estate assets such as farm equipment, automobiles, livestock. So we'll talk a little more about secured notes, but if you're interested in learning more about some more unique investments, we actually do have a webinar on the more unique side of self-directing where we talk about farm animals and livestock, things like that. So private lending basics, note terms. What do you get to decide as the IRA holder? Well, you're going to determine everything that a bank would determine when they're lending money to you. So we also like to say be the bank with your IRA. So you get to determine the amount you're willing to lend, what is the interest rate, and how long will you lend that money for? Is it being amortized or are these interest-only payments? Is there any equity participation? And who will pay the lender's fees? Are there late fees for any late payments? Everything that a bank would normally determine, you get to determine as the IRA holder. And there are a lot of benefits to private money lending with your retirement account. So if you want to be involved in real estate, for example, you could lend money secured by a mortgage or deed of trust. And that way you're involved in real estate, but you don't have to deal with tenants, termites, and toilets, as they say. And so making that investment might be a great way to have your retirement account grow in a very passive way and possibly have good collateral. So you get to act as the bank and determine the terms. You set the rate at which your IRA is going to grow. So for example, if I said I'm going to lend money at 10%, then I know 10% is going to be returned to my IRA. Less liability than owning real estate directly. So if you're lending again secured by a note with a mortgage or deed of trust, then you have, that aspect of real estate investing, but you have less liability and really, less concern. Again, tenants, termites, and toilets. You don't have to deal with those as the lender. It can be a very low maintenance asset. So if you have a good borrower, pays on time, makes regular payments, then you might just check your account and make sure those payments are coming in. And as long as they're coming in, that's all you have to do. You can partner funds among IRAs and individuals, and there's some really creative examples of partnering with private lending. So for example, wrap mortgages or wrap loans, that's a great example of how IRAs can partner and potentially have a great return in their retirement account loan. That is an advanced strategy, and I'm not going to talk about that today. But if you're interested and have questions about wrap loans, let me know, and I can send you a webinar about them that we did with a guest. So we're going to talk now about examples of private lending, and I'm going to use case studies to illustrate these examples. And I think that the case studies really help to outline a couple of different things. One, what is the process? What does the IRA holder do versus what does Advanta IRA do? What paperwork you need for these investments. And it also gives you an idea of the different structures we've seen in a retirement account. So the first case study we're going to talk about is how an IRA can lend to investors. So sometimes we do see IRAs lending to individuals for their primary residence, but that's going to be something we see a lot less than lending to investors or doing commercial loans. And so, and just as a reminder that Advanta IRA does not give investment advice, and we also don't prepare any legal documents. So this is a good time to either get involved with an attorney that can assist you, or depending on the state you live in, a title agent that either can recommend somebody who can prepare documents for you, or maybe they also prepare the documents for loans. It really just depends. But let's go through this first case study and you're going to see how this works. So in this case, Paul has $120,000 in an IRA and he wants his returns to be more consistent. Paul meets a real estate investor who'd like to borrow private money for an upcoming investment. Paul, and this is very important, remember, we don't give investment advice. So Paul is going to vet the property and the borrower before making the loan. So it's important that Paul checks into the borrower, make sure he's going to be a good borrower. He's going to make his payments regularly, not miss any payments. But also, Paul will look at the property, make sure that he is comfortable lending on that property. He also wants to make sure that, whatever information is given to him by the borrower about the property, checks out, that if he should have to foreclose, he could recoup his investment by foreclosing on the property. And once Paul's due diligence is done, he'll talk to the borrower, they'll agree to terms, and once that happens, Paul will bring the documents to us. So he's going to have a note and a mortgage in this case. He agrees to lend $120,000 at 8%. They agree that it'll be a 5-year balloon with monthly payments of $800, and Paul is happy with a first mortgage secured on the property. So how does this happen? Well, Paul is going to open his IRA with Advanta IRA, and we'll assist him with funding the account so he can transfer funds from an existing IRA. He can roll money over from an employer plan. But essentially, he's going to get that money over to Advanta. We're going to kind of either give him directions or we request the funds directly if it's an IRA. He can also add to the funds by making an annual contribution if he'd like to. Remember, this is an IRA, just like any other. Paul provides the note and mortgage, and Advanta IRA reviews all the documents to make sure that it's properly vested, showing Paul's IRA as the lender. And that's very important. A lot of times we receive documents and we're going to see the IRA account holder's name, but what we need to see is the IRA. So Advanta IRA, FBO, Paul Smith, IRA number 1234. And that is going to show how the lender will be shown on all documents. Paul reads and approves the documents. Again, this is another important step in the process because Advanta IRA is not going to review the investment documents and say, hey, Paul, is this the return you were expecting, or is this a good investment? We can't answer those kinds of questions, and we won't look for that in the documents. We're just making sure that the IRA is properly represented. So we're going to have him read and approve all the documents just by approval through DocuSign. And then once that's done, Advanta IRA funds the investment. A couple more points here. Paul is going to let us know who is involved in this transaction. So are they using a closing attorney, a title agent? Where do we wire funds on day of closing? Who are we working with at that company so that we can speak with them if we have any questions? And he does all of that by filling out a form for us called a purchase authorization form. That's going to let us know, hey, these are the individuals involved in this deal. And then once he approves all of the documents, Advanta IRA will follow his funding instructions and send funds out. The mortgage is recorded with the IRA as the lender. The borrower makes payments to the IRA. Now, here a little more specifically, the borrower can make payments directly to Advanta, or if Paul wants to make sure those checks are being received on time, he can have them mailed to whatever address he specifies, but they need to be made payable to the IRA. That's very important because he doesn't want to take constructive receipt of any payments meant for his IRA. They need to go to the IRA directly, so to speak, and deposited. So if he wants to check it off in his ledger that it was received before forwarding it on to Advanta, he can certainly do that, but the actual deposit needs to be made with Advanta IRA. He can also have his borrower send ACH payments if he prefers, and once they're received and deposited to his account, he'll receive an email notification of the amount received, which investment it applied to, and the date it was deposited. Now, I just want to be clear here that Advanta IRA is not a loan servicer. So we are not making sure that the IRA's payments are being received on time. If they required a late payment, we're not looking for that. We're simply receiving funds and depositing checks, and then we take your guidance as to whether or not anything needed to be done. Now, if you said, hey, my borrower is not paying, we're going to leave it up to you to reach out to the borrower to go over any discrepancies. So when the borrower is ready to pay the note back in full, the IRA is paid back. Remember, those funds will go directly back to the IRA, and Paul is ready for his next investment. It's up to Paul if he decides he wants to use a loan servicer. Remember, Advanta IRA is not a loan servicer. And again, Paul will want to monitor those payments received by the IRA, and if there's any problem, he'll reach out to the borrower directly. So if the borrower sent a payment, it appeared to be late, Paul would reach out to the borrower and say, hey, this was received late, you need to make a late payment. whatever it is that needs to be done. And then if Paul needs to foreclose for whatever reason, he would indicate to us that he was hiring somebody for that foreclosure, or whatever the process will be. The IRA will pay any expense for that process, and then the IRA will foreclose on that property. So I didn't see any questions pop up for that first case study, but remember, you can type any questions into the chat box as we go through our examples here. The next example, case study 2, we're going to talk about a joint venture in a retirement account, because I think we do get a lot of questions about this. This is something that we see in an IRA, but remember again that all of the terms for any investment you're making are up to you. So if you decide that you're going to do a joint venture or equity participation with an individual, you're working with them and maybe your attorney or title agent to make sure that the documents are reflective of what you're trying to accomplish. So in this example, Andrea and Steve decide on working together in a joint venture agreement. Andrea has, excuse me, $100,000 in an IRA and is interested in partnering with a rehabber to flip a house. She meets Steve at a local investor club and learns that he has a project that needs funding. Andrea does her due diligence on Steve and the property he's looking to flip. Remember, again, we talked about, in Paul's example, that he was going to make sure to do due diligence and make sure his borrower was going to pay on time. He was comfortable with the deal, but also look at the property to make sure that whatever information he received from the borrower, he can confirm that, look at the property, make sure that he's comfortable with the deal, and then go forward. So Andrea is going to do the same with Steve. And once she feels comfortable with the deal, and like I like to say, feel comfortable with the deal and the person you're dealing with, she is going to agree to work with Steve on the joint venture, and they're going to negotiate terms. Steve agrees to use the property as collateral and some of his own funds as a down payment, and Andrea agrees to loan him the rest of the funds. The loan amount includes the funds to purchase and rehab the property. And again, this is just an example, but something to consider when you're looking at lending. The loan terms they agree on are $100,000 at 5% with equity participation of 1/3 of the profits. In this example, it's a 2-year balloon with a monthly payment of $420, and Andrea receives a first mortgage on the property. Advanta IRA will help Andrea fund this investment, but first, Andrea's attorney is going to prepare the note and mortgage. We'll have Andrea go ahead and read and approve the documents. And then she's also going to fill out the purchase authorization form. Remember, I talked about that form that will let us know who she's working with in case we have any questions on documents or we need to reach out. This way, we'll also know where we're funding this transaction to. And so once she approves everything, provides the information, we will fund the investment. And again, the mortgage is recorded in public record, showing the IRA as the lender. So when the loan is ready to be paid off, Steve is ready to sell the property, and he requests the payoff amount from Andrea. And if Andrea is still working with her attorney, the attorney might provide the payoff amount. And then Steve will send the funds to Advanta in order to pay off the loan. A payoff letter is sent to the title company handling the closing. So how did it work out for our investors here? Andrea's IRA received the repaid principal of $100,000 with monthly payments of $2,500 and a share of the profits of $10,000. So her total earnings are $12,500 for her $100,000. And once the money is paid back, she is ready for the next investment. So she's not required to hold the cash for any period of time because this is simply an investment of her account. Here's Steve's side of the deal. His original loan amount was $100,000. He sold the house for $130,000. The repayment of the loan, points, and interest came to $12,500, and he earned $17,500. So this is just an example, but it gives you an idea of how this process works within a retirement account. So we'll go on and talk a little bit about notes secured by non-real estate, and then also unsecured lending. And then I also do have an example of an IRA borrowing funds to make a real estate investment. So we'll kind of go through these, but again, remember to type any questions you have in the question box and I'll get those answered. So here on this slide, you're going to see using non-real estate as collateral. A note can be secured by really any number of things, but something that you want to make sure you understand is what do you use for a security agreement and where will it be recorded? So I think when we consider real estate, of course, we have the assistance typically of a real estate attorney or a title agent. They help with the process for the investment, but then also recording the mortgage. But when you're using non-real estate as collateral, how does that work? How are you going to put individuals on notice that an item is tied to a note? So that's a big question, and that's a good question for your attorney. And I did have a question pop up. So a question popped up about Andrea charging or Andrea receiving profits, and is that subject to UBIT? Does 401k avoid the tax? The 401k avoids UBIT in some circumstances, but in not others. I am not sure, and I think that's really a question for your accountant as to whether or not the profits Andrea received would be considered business income. I don't know if it has to do with the structure of the deal necessarily. Of course, her interest income is going to be considered more passive, but a share in the profits, that's a great question. I definitely would direct you to an accountant for that question. I'm sorry, I can't answer it, but I'm not sure if it would be considered business income or not. But in that case, would a 401k avoid it? If it is considered business income, no. A 401k avoids unrelated business income tax for debt financed real estate purchases only. So great question. Keep them coming. So a note can be secured by a prohibited investment, for example, life insurance or a collectible, because it's not prohibited per se, but it could make collection of the debt difficult. So when you're looking at this example, what is the investment itself? So let's break it down a little bit. A note secured by a prohibited investment. The investment itself is the note, right? And so since a note can be unsecured, then it could also be secured by a prohibited investment. But what will you do if you're, kind of faced with non-payment of the note? There are a couple different things. And, of course, you would want to talk to your attorney and find out what they would recommend, but you can always distribute the note to yourself personally. This would be typically a taxable event, but it will depend on the type of account that you have and your age, of course. And then once you take possession of that investment personally, you can now, repossess the item that the note was secured by. You could sell the note. So there are individuals out there that buy notes that, non-performing notes. Of course, you could, get an attorney involved to write a demand letter and make sure that you're working with an individual that can assist you with that. And again, it's important to understand how you'll put individuals on notice if you have a non-real estate asset as collateral. If the note is secured by stock in a company, check to see that the business is taxed in case your IRA ends up owning the stock, how it's taxed. So this is very specific, but S corps cannot have IRAs as shareholders. So you want to make sure that if you're lending money to a company and secured by company stock, that if it is an S corp, that you have a plan for the IRA, because the IRA cannot be considered a shareholder, and that's specific to S corporations. You may be subject, or you may subject the IRA to unrelated business income tax. So kind of going back to that last question, understanding where UBIT will apply to a retirement account. And again, understand what to use as a security agreement and where it would be recorded. So for example, something like, farm equipment, restaurant equipment, sometimes you can use a UCC filing. How will you put individuals on notice that that item is collateral of a note? A question popped up again about the joint venture. Could she charge more interest to avoid any possible UBIT or fees? The structure of the deal is up to you. And of course, how much interest you can charge might depend on usury in the state that you reside. And so ultimately, Advanta is going to leave the structure of the investment up to you. And maybe, again, having a real estate attorney or an attorney help you structure that to avoid any issues with laws in the state you reside might be a good idea. Okay, so our next example, we're going to talk about unsecured lending. And again, feeling comfortable with the deal and the person you're dealing with, you could lend money unsecured. And we do see individuals lending money a lot of times to businesses, but sometimes to individuals for whatever purpose. And so in this example, Tom's loan deal, Tom has 50,000 in a SEP IRA, and he has a friend who wants to expand his business and needs short-term capital. Tom decides to lend money from his SEP and is willing to lend the money without any collateral. Tom drafts the unsecured promissory note, listing his IRA as the lender. In this example, he lends 50,000 with an interest rate of 10% and a 1-year balloon, and this is a lump sum payment of 55,000. And the reason I use this example a lot of times is just to really illustrate that the terms of the note are your own. So kind of backing up to that last question, could you restructure the deal, Andrea and Steve's deal, to maybe not take a share of the profits, but maybe there's a fee, or maybe there is larger, a higher interest rate in order to have, more income from the note versus, profits at the sale of the property. In this example, you'll see that Tom and his borrower agreed that this is a lump sum payment. So this is a great example of how you're structuring the deal that works for you and for the borrower. So in this example, he says, hey, I don't require any payments over time, and then it'll just be a lump sum payment back to my retirement account when the note comes due in 1 year. And so Advanta didn't say, hey, Tom, how about, you structure the deal this way? Tom said, hey, this is what I'm agreeing to with my borrower, and we just help execute that through the IRA. So that's a great example. Payments can be monthly, they can be quarterly, it can be a one-time payment. It's completely up to the IRA holder and their borrower. Special considerations of unsecured notes, and this is very important because there is no title company involved. Advanta IRA must have the original note in our possession before funding. So that means that if you're working with a borrower and they want funding tomorrow, then it is absolutely necessary to get this originally wet ink signed note to our office prior to funding. Since unsecured lending is riskier than conventional mortgages, the interest rates do tend to be a little higher. So think about credit card interest rates. Make sure you know your borrower because it could be difficult to recover in default. So again, talking to an attorney, that can help you understand what recourse you have if the borrower does not pay. I had a question pop up about a specific investment, and I don't want to go into that here, but please reach out to your account manager. If you're not an account holder yet, please feel free to reach out to me, and I can maybe answer your questions, but that might be more a question for the provider. So in this next case study, we're going to talk a little bit about how an IRA can borrow to purchase real estate. And we talked a little bit about unrelated business income tax, and you're going to see how that comes into play here in this example. Before I go on, I did have another question pop up. If an unsecured note needs to be extended, can you change the interest rate for the extended portion? That's a great question. Honestly, you can, negotiate whatever terms you want to with your borrower. And so, you just want any extension to reflect what you're doing in with that extension. So, if you're extending the note, then you want to be clear about what would apply to, those new terms. So Mike is going to invest in real estate using his retirement account, and he wants more buying power in his retirement account. So in order to do so, he's going to borrow. He has an old 401k worth 160,000, and he finds a house for 150,000 that doesn't need repair work. So in this example, it's important to note that he's buying a property that he considers turnkey. It doesn't need a lot of work done, but he wants more buying power. And so instead of using 100% of what he has in the retirement account, he's going to borrow. Mike uses 60,000 from his IRA as a down payment and finances the rest with a non-recourse loan so he can buy 2 properties. So he's basically saying, hey, I'm going to use a loan so that I can double the number of assets I hold in my account. And that loan does have to be non-recourse. So I talk a lot to people who call me and ask me questions about buying using a loan. And usually what I say is there's some more moving parts there. Typically people buy in cash. You can also partner retirement accounts. You can bring in partners that are non-retirement accounts. or not retirement accounts, but every once in a while somebody does use financing, and there are two things to know. One, the loan has to be non-recourse, and two, it does expose an IRA to unrelated business income tax. Now, a 401k might not be exposed to unrelated business income tax under the same circumstances, but an IRA would have that additional burden, so to speak, and it is a tax to the IRA, not the IRA holder. So we'll go through that in this example. So the loan is for $90,000 with a 6% fixed rate loan for 30 years, and the monthly payment is $540. The IRA has to make this payment. So keep that in mind when you're looking at borrowing with your IRA. Mike cannot guarantee the note personally, thus the bank can only foreclose on the IRA. So that's the non-recourse loan language. So you're going to be looking to make sure that if you're going to borrow, that the bank understands it has to be non-recourse. It also does not have to be a bank. You can be borrowing private money. This can be seller financing. Whatever it is, it has to be non-recourse. The loan is to the IRA directly, and the IRA repays the loan out of the account. Lenders for non-recourse typically want 30 to 40% down with cash in reserve. Income received on the mortgaged real estate is subject to unrelated business income tax, UDFI. And so again, that is income related to the amount of debt. And we'll talk about that in just a minute. Only income based on the percentage of financing is subject to the tax. So the other percentage of the income is going to go back tax deferred or tax free. And then percentage decreases as the loan gets paid down. So if he borrows, 60%, as he pays down the mortgage, the percentage of financing goes down. And so the amount on the income that's going to be taxable is going to go down as well. So every year that he pays a little more down, he's going to owe a little less in unrelated business income tax. And then once the loan is paid off for a full 12 months, he no longer will owe any unrelated business income tax. The IRA files IRS Form 990T and can deduct percentages of expenses and depreciation. No 990T is necessary if the total unrelated business income tax liability is less than $1,000. And tax is paid at trust tax rates. So here's an example of calculations for unrelated business income tax. And this is really just to give you an idea of what you're looking at when you're considering something like this. And usually what I tell people is you should get your accountant involved, run through some calculations, and determine if this is the right structure to invest for you. So in this example, remember that he made this investment turnkey, so he didn't need any work on the property. And he's receiving $2,000 a month in rental income back to the IRA. In the first column on the left, you're going to see the impact with financing, and then you're going to see the all cash purchase. So $24,000 a year is being returned in rental income. Loan payments are paid out of the IRA. The total annual amount in loan payments $6,500. Total expenses $6,000. Net prior to UDFI $11,500. And then net income subject to UDFI $6,900, again based on percentage of the loan. And then at 28%, the tax due is $1,932, and this does not include depreciation and deduction. So you can see where, potentially these moving parts can be a little scary, but once you do the calculations, it might still work in your deal. It may not, but it might work in your deal. On the right column, you're going to see the all cash purchase, same $24,000 a month in rental income. However, now, of course, you don't have a loan to pay back, so the $6,500 goes away. You still have the same in expenses. You still have the same, or you have a different net income because you're not paying the loan. You're not going to have anything subject to tax. In this case, it's going to come back tax deferred or tax free. And so the total income is going to be $18,000 when you don't use financing in this example. Now, these two examples side by side, of course, the income over the year looks better with the all cash purchase. But remember, Mike did this so that he could have more buying power and buy an additional asset. And so we have to leave it up to you as to whether or not this is a good strategy. But this gives you an idea of what that looks like. Remember, there's more moving parts when you're using a loan to buy real estate in a retirement account, but it doesn't mean it won't work. It's just definitely something you want to do your homework on. So I had a question pop up about checkbook control. And if you're using checkbook control, do we still require the wedding promissory note at our office before funding? The answer is no. When you have checkbook control, and we do have a webinar on checkbook control if you're interested in learning more, you essentially are setting up an LLC or a trust as the entity owned by the IRA. Within that entity, you will hold any number of investments, and those investments will be titled in that entity. So let's say that you have an LLC for checkbook control and it's ABC LLC. Well, ABC LLC is going to have a checking account. The IRA will fund ABC LLC's checking account, and then as the manager, you write checks for investments. And because you're the manager, you can determine what you will require for those investments. The investment would be with showing the LLC as the lender in that case, or any investments you make would be under the LLC's name. But as the manager of that LLC, you're going to determine what you're going to require. I don't see any other questions, so I'm going to kind of wrap up the webinar here. But if you do have questions, we just have another minute left. I'm happy to answer them. Remember that the handouts are loaded into the navigation, so just look for handouts and you can download them there. Any IRA or former employer plan qualifies. You choose the investment and all expenses are paid by the IRA and any income is received by the IRA. Opening an account is really easy. And typically, we tell people that if you're starting to look for your self-directed investment, now's the time to open the account. It can take a little bit of time to fund the account, but opening an account can happen in as quick as 24 hours. And then we're waiting on funds either from your IRA custodian or your old employer plan. We help you fund the account, whether it's us giving you information to provide for a rollover or actually requesting funds for an IRA to IRA transfer. And then you're ready to start your investing. And sometimes people do find an investment and then come to us and say, hey, I have a closing in 2 weeks. Can I get this done? And we'll help you with that process. But it is truly better to have your account open first. That way you have the vesting for any investments you're going to make, and we can help you with the strategy kind of as it unfolds. Once you're ready for purchase, you would let your account manager know and they would help you with that process. I had a question pop up about being the manager of the IRA-owned LLC. So you can definitely go down a rabbit hole with being the manager of the LLC. So, there's Swanson versus Commissioner. There has been other case law to back up sort of that decision, but in that case, Swanson was challenged by the IRS for having an LLC where he was the manager. And the tax court said, you know what, he's not doing anything prohibited. The IRS didn't say that he couldn't be the manager of that LLC, and so they allowed it. And so that was sort of the big case that, everybody kind of considers when they're looking at whether or not they want to be the manager. So we leave that up to you, but if you'd like a legal opinion, you certainly could get one. If you decide you want to be the manager and you say, hey, I'd really like my attorney to, approve of this, it's always a good idea to have backup on any decision you make. When you have a trust, you cannot be the trustee. And I think that contrast there is why we probably see more LLCs than we do trusts. But in the case of a trust, you do have to have a non-disqualified third party act as trustee, and the IRA in that case would be both the grantor and the beneficiary of the trust. So I hope that's helpful. Here's my contact information again. If you have any questions that you didn't feel you wanted to ask on the webinar, please feel free to reach out to me. Also, the slides, I'll leave them up for just another quick minute. If you want to download the slides under handouts, you can also, like I said, reach out to me with any questions. If I mentioned any webinar trainings during this webinar, please feel free to reach out to me and I'm happy to email you the link so that you can check them out. That includes checkbook control and the different types of entities and structures you can use for that. I also talked about unrelated business income tax, and my partner Alex does a deep dive into that topic. He did that last week, and so I'm happy to send you the webinar for that. Since I see no other questions, I'm going to close the webinar, but thank you so much everyone for joining. I hope this has been a great educational session, and we'll see you soon.